As of Wednesday afternoon, interest rates are officially the highest that they've ever been since 2006 in nearly 2 decades. And not only that, but this week, a fourth bank collapse in a domino effect that doesn't seem to be quite over just yet. In this video, we're going to break down why all of this has such a large impact on the Kansas City real estate market and your bottom line, whether you're buying or selling a home this year. Let's get started. Now, if you've been seeing all of these headlines, or maybe you watch these YouTube videos that we do weekly, you know that this was not the first time the Federal Reserve has increased interest rates. It wasn't the second, wasn't the third. This was the 10th time they've raised rates in just a 13-month period, which started last March. That was when we realized that inflation was hitting its peak and we had to do something, and that was the solution, was to raise rates. The problem is that every single time they do this, it ratchets up economic pain. It turns up the temperature just enough to really slow the economy. And what we've seen as a result of that here in Kansas City in our housing market is a huge housing shortage, as a lot of would-be home sellers look at that sub 3% mortgage rate and they look at today's mortgage rates, which are hovering around 6.4%, and it just doesn't make sense for them to double their mortgage rate or double their monthly expenses for the same house they've got right now. It's also causing a problem for all of the would-be home buyers who are finding it just unaffordable, or who can't even qualify for the same loan because of how much more expensive that monthly payment is. But it's not just us here in the Kansas City real estate market that are suffering. We've also seen all of these banks collapse over a 2-month time frame. At first, it was Silicon Valley Bank, and then it was Silvergate, and then it was Signature Bank, and now this week we've got First Republic Bank, a fourth bank in a domino effect that seems like it's not quite over just yet. Reason for this is if we go back a few years to those really rock bottom interest rates, COVID was a big problem. We were in lockdown and the government wanted to do everything possible to avoid an economic fallout. Well, all of those banks took their money and they put them in assets that now every time the government increases interest rates, they're losing value on those assets. And it's getting to a point where with every interest rate hike, the amount of money that those assets have lost in value has reached over $100 billion. Now, imagine if you invested in a stock and that stock plummets, let's say 50% the next day. Well, no big deal. It's not like you're going to sell it, right? Why not just hang on to it until it inevitably bounces back? The problem is that they've got to have money in the bank in case somebody wants to withdraw their money. Hence the bank run. And why all of these banks are collapsing is because a lot of people are trying to get access to their money. And when the bank doesn't have any cash on hand, they've got to sell these assets at huge losses, and the bank eventually fails, gets taken control of by the government, and then the government sells these banks to big national chains like JP Morgan Chase. Now, here's an article in the Wall Street Journal that documents this very specifically and says that First Republic's undoing was triggered by the Federal Reserve's rapid series of interest rate increases, which led depositors to seek better returns elsewhere. Long story short, it made it more expensive to hold on to all of those customers, and when they just couldn't compete with the large chains, those customers inevitably took their money and left. The problem is that the bank had to sell all of those assets in order to make sure that those customers actually had money to withdraw. So in other words, as a result of these interest rate hikes that have happened one after another, these regional banks are failing. They can't afford these interest rate hikes. It's squeezing their margins, diverting customers away from them, and when they inevitably collapse because they don't have big reserves like a JP Morgan Chase, that's eventually who ends up buying them out, and it's just a massive series of consolidation between small and big banks. Now, this independently is a huge risk for the economy. It impacts lending standards. If they start to tighten those, it could make it more expensive to qualify for a mortgage. It also, as we saw in 2008, can have catastrophic knock-on consequences for the rest of the economy. So we're going to put a pin in this for now. It's very uncertain what this will amount to and whether this will continue, but it all has to do with whether or not the Federal Reserve continues to increase interest rates, or whether they hit the pause button and maybe even decrease interest rates over the next year. Now, before we break down what all of this means specifically for you in the Kansas City real estate market, I know some of that stuff was boring. We're through the thick of it. This is the stuff that really matters. If you're still with me, I appreciate it. Let me know by hitting that like button, subscribe for weekly real estate market updates. And if you like my style, if you think we'd be a good fit and you're buying or selling, I'd love to work with you. A little bit more on that at the end of this video. But now, exactly what this all means for you and how it impacts selling or buying your home in Kansas City. Now, in terms of the housing market, all of this was expected. The mortgage industry knew that this was coming, so all of this was priced into mortgage rates as of last week, which they've been a little volatile, and I think we can expect some more volatility over the next month. But let's break down what happens if the Federal Reserve decides to hit the pause button and what happens if they continue increasing interest rates. Here's an article from Housing Wire which breaks these down specifically and says a hike in the short term doesn't quite matter, meaning this recent hike, even though it has a big impact on the broader economy, will not impact mortgage rates that much because mortgage rates are based off of long-term calculations rather than shorter-term calculations. It also says that the Mortgage Bankers Association expects the Federal Reserve to pause rate hikes in June, which is based on their statement released on Wednesday. Now, if in fact the Fed does pause interest rate hikes, it'll mean that potential homebuyers and mortgage lenders may be breathing a sigh of relief. In other words, we can sit back, kick our feet up on the desk, and know that mortgage rates are going to fall and likely continue to fall over the next year, as well as it's a good signal that inflation's under control and that we don't have to keep increasing interest rates. But there's a big chance that's not quite what's going to happen. It's almost like a coin toss. We just don't know yet. We don't have the numbers to look at with regards to inflation, which is why we keep increasing interest rates in the first place. The Housing Wire article does break down exactly what would happen if they do increase interest rates, and it's not good, especially for the Kansas City real estate market. We already have a supply shortage. Increasing interest rates would make it even more implausible that many home sellers eventually sell their home and trade up for a mortgage that's double what they're paying right now. It also makes it harder for current home buyers to qualify for a mortgage because that monthly payment gets expensive very, very quickly compared to just a couple years ago where their buying power is more than double what it is today. And the third thing that it does is increase the attractiveness of accepting a cash offer, which could encourage investors to flee back into the market now that they've got more negotiating power than most home buyers who are purchasing homes with mortgages. Now, while nobody has a crystal ball and we can't quite predict what these economic numbers will look like and what the Federal Reserve will eventually decide to do, one thing we know for certain is that right now we are in a window of opportunity. Now is your chance, because if the government does increase interest rates, it's going to be more expensive. If they don't increase interest rates, it's going to give the assurance to a lot of home sellers and home buyers that there is relief at the end of the tunnel. There's light at the end of the tunnel. And if that happens, I would expect to see, yes, more inventory come on the market as home sellers eventually trade up or trade down into their new homes. But I'd also expect to see all of those home buyers who previously could not afford those mortgage rates jump into the game, causing more competition, bidding wars, overpriced offers, meaning that home prices shoot up even though mortgage rates are going down. It's like a seesaw and there's just no equilibrium. It's either one goes up or the other goes down. And the reason right now is the window of opportunity is because either way, it looks like it's going to be more expensive. But right now is the calm before the storm, and that storm won't come until next month, and I'll be right here to report it for you. If you enjoyed this video, hit that like button, subscribe so you see future updates because this absolutely matters. There are a lot of question marks up in the air regarding the broader economy, and this will impact a lot of people's bottom lines in this real estate market. And if you'd like to have a conversation about what all of this means for you and how you can take advantage of opportunities that all of these dynamics create, I would love to have a conversation with you about it. All of my contact info is below, so give me a call, text, or email. We can schedule a time to talk and make sure that you've got a clear route to victory, whether it's buying or selling a home in Kansas City this year. Thank you for watching the video. I'll see you on the next one.